Audrey Fisk was 67 years old, sitting at her kitchen table in the second week of February, and the space across from her was empty for the first time in 41 years. Her husband, Don, had died the previous September. Lung cancer. It moved fast. They had savings, a house with no mortgage, 2 IRAs, a joint brokerage account, and a 401 SEC Don had rolled over years ago when he left the plant. They had done what people do when they are careful. They saved. They planned. They paid off the house early. They named each other on every account. Audrey thought the hard part was behind her. Then the tax forms arrived. She spread them across the table the way Don used to, organized, methodical, one pile for each account. And when she added the numbers and looked at what she owed, she sat back in her chair and said out loud, to no one, that this could not be right. It was right. The number on the line was not a mistake. It was not an error from the brokerage or a misprint from the IRS. It was the result of a set of tax rules that almost nobody explains to a surviving spouse before the worst year of their life becomes one of the most expensive. I'm Harrison Vale, a former estate planning attorney and retirement risk analyst, and this is Legacy Defense Report. I spent my career sitting across from families who did everything right on paper and still walked into legal and tax traps that cost them the house, the savings, or a chunk of the inheritance. Not because they were careless, but because nobody translated the rules before the damage was done. That is what this channel is here to fix. If you want these rules explained before a tax notice, a probate filing, or a family dispute makes the lesson expensive, subscribe now. And drop your state in the comments, because community property rules, state income taxes, and estate recovery laws can change the entire picture depending on where you live. That one detail matters more than most families realize. Now go back to that kitchen table. What happened to Audrey is called the widow's penalty, and it is not a rare edge case. It is a structural feature of the federal tax code that activates automatically the moment a spouse dies. No form triggers it. No election causes it. It simply begins. Here is the plain English version. When two spouses are alive and filing taxes together, they use the married filing jointly brackets. Those brackets are wide. A married couple can have roughly $94,000 in taxable income in 2026 and stay inside the 22% bracket. They can earn up to around $201,000 before hitting the 24% bracket. The brackets are built to accommodate 2 incomes, 2 Social Security checks, 2 RMDs pulling from retirement accounts at the same time. The year a spouse dies, the survivor can still file jointly for that final tax year. 1 more year of the wider brackets. That is the last grace the tax code offers. The following year, the surviving spouse files as a single person. And the single filer brackets are not just slightly narrower. They are almost exactly half the width. A single filer hits the 22% bracket at around $48,000 in taxable income. They hit 24% at roughly $103,000. The income did not double. The tax brackets simply shrank, and everything above those lower thresholds gets taxed at a higher rate. Audrey's income did not change much from the year before. She had her Social Security, an RMD from her own IRA, and a small pension Don had set up before he retired. But filing as a single person moved a portion of her income into a bracket she and Don had never touched together. The bill was not catastrophic, but it was real, and it was permanent, and it was going to happen again next year and every year after that. That is only the beginning of what changed. The bracket shift is the foundation of this problem, but it is not the whole building. There are 4 specific assets that sit inside this new tax reality and behave in ways a surviving spouse almost never expects. 4 assets where the rules at death are different from the rules during marriage. 4 assets where the timing of what you do and when you do it can mean the difference between preserving what your spouse helped build and watching a significant portion of it transfer to the IRS instead of your family. The first one alone surprises most financial professionals who have not reviewed a client's estate specifically through the lens of spousal death. And for families who find out about it after the fact, the window to fix it is already closed. The first asset is the traditional IRA. Audrey had her own IRA, and Don had his. They had named each other as primary beneficiary on both accounts, the way every financial checklist tells you to do. That initial part of the setup was exactly right. But what happened after Don died, the sequence of decisions in the weeks that followed? is where families quietly make a mistake that costs them for the next decade. When a spouse dies and leaves behind a traditional IRA, the surviving spouse has options that no other beneficiary in the world gets. A child who inherits an IRA from a parent cannot do what Audrey could do. A sibling cannot. A friend named as beneficiary cannot. Only a surviving spouse gets a specific legal choice that can protect the account from a brutal forced withdrawal schedule. That choice is called a spousal rollover. Think of it like this. When Dawn's IRA passed to Audrey, she could treat that account as her own, not as an inherited account with Dawn's name still attached. Her own IRA, with her own rules, her own required minimum distribution schedule based on her age, and her own timeline. She could roll the funds into her existing IRA or open a new one in her name, and the account would behave as if she had always owned it. The RMDs would follow her age, not a forced depletion clock. That matters enormously because the alternative is what non-spouse beneficiaries face. If Audrey had, for any reason, accepted the account as an inherited IRA rather than rolling it over as her own, if the paperwork was filled out incorrectly, if the financial institution set it up wrong, if nobody caught the distinction in the fog of grief, she would have been locked into the 10-year rule. The 10-year rule means the entire account balance must be withdrawn and taxed within 10 years of the date of death. No exceptions for the size of the account, no exceptions for the surviving spouse's income. The IRS requires the account to be emptied, and every dollar that comes out is ordinary income, taxed at whatever bracket the survivor is now sitting in. The single filer bracket, the narrow one. On a $400,000 IRA, that can mean pulling out $40,000 or more per year, on top of Social Security, on top of the survivor's own RMDs, on top of any pension income. All of it stacking into a tax return that is already compressed by the filing status change. Families have watched $400,000 accounts effectively lose $80,000 to $100,000 in taxes over that 10-year window that would never have been owed if the rollover had been handled correctly in the first place. The spousal rollover is not complicated, but it requires the right paperwork, filed with the right institution, labeled correctly. Grief does not pause for paperwork, and some financial institutions default to inherited IRA treatment if the surviving spouse does not explicitly request otherwise. This is the kind of decision to review with a CPA or a state attorney before the account is touched, not after. The rollover election, once made incorrectly, is not always reversible. Ask yourself right now, do you know how your spouse's IRA beneficiary designation is written? Not from memory, from the actual form. Comment below whether you have checked that document in the last 5 years, because an outdated form can override everything else. Now the second asset, the 401. A lot of people assume a 401k and an IRA follow the same rules after a spouse dies. They do not. Employer-sponsored 401 plans are governed by a federal law called ERISA, and ERISA gives surviving spouses a unique protection that IRAs do not automatically carry. In most 401k plans, federal law requires that the surviving spouse is the automatic primary beneficiary, unless the spouse has signed a notarized waiver saying otherwise. This protection exists specifically because Congress recognized how often retirement savings disappear from families when a plan participant dies. But here is where the trap opens. When Dawn's 401 passes to Audrey, she has a choice similar to the IRA situation, but with different timing rules attached, and a different set of risks if she moves too slowly or too quickly. If Audrey leaves the money inside Dawn's former employer's 401 comp plan, she is subject to that plan's specific rules. Some plans allow surviving spouses to stay in the plan and take distributions on their own schedule. Others require the account to be distributed within a fixed window. The plan document controls not Audrey, not her attorney, and not the account balance. The plan document, if she rolls the 401k into her own IRA, which is generally the cleaner, more flexible long-term move, she gains control over RMD timing and investment choices. But the rollover must be handled as a direct rollover. If the plan cuts a check made out to Audrey, instead of directly transferring to the IRA custodian, she has 60 days to deposit it, or the entire amount is treated as a taxable distribution. 60 days. In a year when she is dealing with a death certificate, a probate file, utilities in Dawn's name, and a kitchen table full of paperwork. 20% of the check will be withheld for taxes automatically. If she misses the 60-day window, the withholding does not come back. The distribution is taxable income for that year. On a $300,000, $401, that is $60,000 withheld, a potential tax bill of $40,000 or more, depending on her bracket, and a permanent reduction in the retirement funds she was counting on. The rule is not punishing carelessness. It is punishing timing. And the families who lose money here almost always lose it in the same year they are least equipped to catch the mistake. While Audrey was sorting out the IRA rollover paperwork and figuring out what to do with Don's 401, two more assets were sitting in a completely different kind of danger. One of them tied to a tax break she had always assumed she still had, and one of them attached to the house where she had raised her children and intended to live out the rest of her life. The third asset is the joint taxable investment account. Audrey and Don had built this account over 30 years. Index funds, a few dividend stocks, some bonds they had shifted into as they got closer to retirement. The account was worth around $380,000 when Don died. They had put in roughly $160,000 over the decades. The rest was growth. And that gap between what they paid in and what the account was worth, that $220,000, is called unrealized capital gains. While both of them were alive, those gains sat quietly in the account. Nobody owed tax on them yet. You only owe capital gains tax when you sell. That is the rule most investors understand. What most investors do not understand is what happens to that cost basis. The original purchase price the IRS uses to calculate the gain at the moment one spouse dies. This is one of the most valuable tax rules in the entire code, and it is one of the least explained. When a person dies, the assets they own receive what is called a step-up in basis. The IRS resets the cost basis of those assets to their fair market value on the date of death. If Don and Audrey had bought shares of a fund at $10 per share 30 years ago, and those shares were worth $60 per share the day Don died, the IRS treats the basis as $60. The 30 years of growth, for tax purposes, disappears. If Audrey sells those shares the following week at $60, she owes nothing in capital gains. The gain was effectively forgiven at death. That is a powerful protection. But it comes with a condition that depends entirely on what state Audrey lives in and how the account was titled. In community property states, and there are 9 of them, including California, Texas, Arizona, and Washington, both halves of a jointly owned asset receive the step-up when one spouse dies. Audrey's half and Don's half both get reset to the date of death value. The entire $380,000 account steps up. She could sell the whole thing the next day and owe no capital gains at all. In common law states, which is the majority of the country, only the deceased spouse's half of the account receives the step-up. Audrey's half stays at the original cost basis. So if the account was split evenly, she gets a step-up on $190,000 worth of assets. The other $190,000 still carries the old basis. If she sells the whole account, she owes capital gains on the appreciation embedded in her original half. Drop your state in the comments. This is not a small distinction. A family in California and a family in Ohio can be sitting on identical accounts and face completely different tax bills after a spouse dies. The account looks the same. The tax outcome is not. The mistake Audrey almost made, and the mistake her neighbor actually made 2 years earlier, was selling the entire joint account in the months right after Don's death before getting clarity on which assets had stepped up and which had not. Her neighbor sold everything in an emotional rush to simplify the finances. She did not realize that half the account still carried a low basis, and the capital gains bill that arrived the following April took $18,000 she had not budgeted for. Audrey caught it. Her neighbor did not. The protective move here is not complicated. Before selling anything in a joint taxable account after a spouse dies, get a date of death valuation from the financial institution. Confirm which assets received a full step-up and which received a partial one. Then have that conversation with a CPA before placing a single sell order. Selling the right assets in the right sequence can save a surviving spouse tens of thousands of dollars in a single tax year. Now the fourth asset. And this one carries the most emotional weight of anything on this list: the family home. Audrey and Don had paid off the house years before he got sick. It was worth around $620,000 when he died. They had paid $180,000 for it in 1994. The gain was $440,000. And for 30 years, Audrey had assumed that when she eventually sold the house, the married couple's capital gains exclusion would protect most of that profit from tax. She was right while Don was alive. Federal tax law gives a married couple filing jointly a $500,000 capital gains exclusion on the sale of a primary residence, as long as they have lived in the home for at least 2 of the last 5 years. That means the first $500,000 in profit from selling the home is tax-free. On a $440,000 gain, Audrey and Don would have owed nothing. Zero. Don died. Audrey became a single filer. The single filer exclusion is $250,000, not $500,000, half. On Audrey's $440,000 gain, that means $190,000 is now exposed to capital gains tax. At a 15% federal rate, which is where she sits after the bracket shift, that is $28,500 owed to the IRS on a home she and Don built their entire adult life inside of. But there is a window, and it is closing. The tax code gives a surviving spouse a 2-year period after the date of the spouse's death, during which they can still use the full $500,000 married exclusion as long as they sell the home within that window and meet the residency requirements. 2 years. After that, the exclusion permanently drops to $250,000 and it does not come back. Most surviving spouses do not know this window exists. The ones who find out about it in year 3 are the ones calling an attorney after it has already closed. Audrey had 14 months left on her window when she finally sat down with an estate attorney and understood what she was looking at. She had not been planning to sell. She loved the house. But knowing the window existed gave her a real choice whether to sell before it closed, downsize on her terms and protect that gain, or stay and accept that the exclusion would shrink permanently. That is a choice. Walking past the deadline without knowing it existed is not a choice. It is just a loss. The house is where this problem becomes the most personal. It is also where the tax clock is the least forgiving. And the question Audrey had to face, what do I actually do now, is the one that the next part of this answers directly. Audrey did not lose everything. She caught enough of it in time. Not all of it. Her neighbor's capital gains mistake was already done, and she watched that happen from across the street without understanding it until it was too late to help. But Audrey herself got to an estate attorney 14 months after Don died, and that conversation changed the trajectory of what her kids were going to inherit. What she learned in that office is what this final part is about. There is a version of this story that goes differently. Not because the tax rules change, not because the IRS makes an exception for grief, but because the surviving spouse, or better, the couple together while both are still alive, understood where the traps were before the death certificate arrived. That version of the story exists. Families are living it right now. And the difference between that family and Audrey's situation is not intelligence, not wealth, not the size of the accounts. The difference is whether someone explained these 4 rules before the worst year made them expensive to learn. So here is what to actually do. The first conversation is about the IRAs. Both spouses should pull out the physical beneficiary designation forms, not the account statements, not the online portal summary. The actual forms on file with the custodian, and confirm that each spouse is named correctly as primary beneficiary. Then confirm that a CPA or estate attorney has looked at the account structure and understands the spousal rollover option, so that when the time comes, the surviving spouse or their advisor knows to request it explicitly. The rollover election does not happen automatically. The institution will not always default to the most protective option. Someone in the family needs to know to ask for it by name. The second conversation is about the 401. If either spouse has a 401-IC from a current or former employer, request a copy of the summary plan description, the document that explains exactly what the plan allows a surviving spouse to do. Find out whether the plan requires distribution within a set window, whether it allows the surviving spouse to remain in the plan, and whether a direct rollover to an IRA is available. Know the answer to those questions now, not during the 60-day window after a check has already been cut. The third conversation is about the joint taxable investment account. Find out what state you are in and whether it is a community property state or a common law state. That answer determines how much of the account's cost basis steps up at death and how much does not. Then ask a CPA to walk through the tax consequence of selling any appreciated assets in that account before selling a single position. The step-up in basis is one of the most powerful tax protections available to a surviving spouse, and it is completely wasted if the assets are sold before the date of death valuation is established and applied correctly. The fourth conversation is about the house. If you own a home that has appreciated significantly and you are married, find out what your current capital gains exposure would be as a single filer. Calculate the gain current value minus what you originally paid and compare it to the $250,000 single filer exclusion. If the gain exceeds that number, you need to know about the 2-year window before you need to use it. Talk to a CPA or estate attorney about whether selling within that window makes financial sense, or whether the emotional and practical cost of selling the home outweighs the tax savings. That is a personal decision, but it needs to be an informed one, made with the window in mind, not discovered after it closes. None of these 4 conversations requires an emergency. None of them requires a health scare to justify. They are the kind of questions a couple in their late 50s or 60s should be asking during a regular annual review with whoever handles their taxes or estate documents. The danger is not that every surviving spouse loses half of everything. The danger is the gap between what families assume and what the rules actually do. Audrey assumed the IRA would transfer cleanly. She assumed the 401k worked the same way. She assumed the step-up applied to the whole investment account. She assumed the $500,000 home exclusion would still be there whenever she was ready. Every one of those assumptions was either wrong or conditional on something she did not know to check. She is not unusual. She is the rule, not the exception. The families who avoid this are not smarter or luckier. They are the ones who had one honest conversation with a CPA or elder law attorney before the death, not after. Before the grief, not inside it. Before the 60-day window started, not on day 58. Before the 2-year home exclusion expired, not in month 25. Timing is the entire game here. The IRS does not grade on a curve for circumstances. The 10-year depletion clock does not pause because the family is still sorting through the paperwork. The capital gains bill does not arrive with a sympathy note attached. The home exclusion window does not extend because the surviving spouse was not ready. What does change is what you do before those clocks start. Write yes or no in the comments. Have you and your spouse sat down with a CPA or estate attorney specifically to review what happens to your accounts if one of you dies first? Not a general financial plan meeting. Not a will signing. A specific conversation about account titling, beneficiary elections, basis step-up, and the widow's bracket shift. If the answer is no, that conversation is the one to schedule before anything else on this list. Do not move money, sell assets, or make rollover elections based on a video. Take this information to a professional who can look at your specific accounts, your specific state, and your specific tax picture. The rules in this video are real, and they are accurate in their general form, but the details change by state, by account type, by plan document, and by income level. The danger is not that this information will scare you into acting rashly. The danger is waiting until the circumstances force a decision that should have been made calmly, with time, and with the right person in the room. Audrey sat at that kitchen table in February and felt like the system had taken something from her family. And in a narrow, technical, perfectly legal sense, it had. Not because she was careless, because nobody handed her this information while Don was still alive to help make the decisions. You have it now. Subscribe, save this, and send it to the person in your family who handles the paperwork. Because the rules in this video do not announce themselves before they activate, and the families who know them early are the only ones who still have options when the moment arrives.